As of this morning, the best performing group in the TSX over the past month was real estate. And of course, a lot of that is about lower borrowing costs. We are seeing some 5-year mortgages in Canada now below 5%. We're joined by Canaccord analyst Mark Rothschild. Thanks very much for coming on the show.
My pleasure.
Mark, you note that moderating inflation, lower rates, typically good for real estate. You have some favorite names for us. We can't get into all of them, but tell us what could go. And I mean, just 1 month, excuse me, just a month ago, you felt many of the REITs were undervalued. That's not the case anymore. What could go wrong, though, with this real estate rally?
Well, I guess I would start by saying that the recent move down in the 10-year rate is definitely very good for real estate for commercial real estate values for the REITs in general. We had a lot of uncertainty on where property values were over the past couple of years as rates have been rising, and this definitely provided a boost and is leading to fund flows back into the sector. So in this scenario, we think that while the recent rally has been great for the REITs, it could continue into the new year, although probably you've gotten a decent chunk of that performance already, especially for some of the REITs. But, one of the things that we're concerned about is that what if inflation doesn't slow enough to allow for interest rates for the Bank of Canada to reduce rates in 2024, or at least not as much as people expect. And that could be for different reasons. Some people are speculating that the level of immigration can keep inflation high. There's different reasons that can impact or drive that. If that were to happen, we think that the 10-year can back up, and that would definitely put a halt to the REITs rally, at least for many of the REITs. And while it would be good on the economic side for many REITs, and a strong economy does help them boost rents, what we've seen in the past month or so is that it's not fundamentals that in the short term are going to impact the REIT performance. It is interest rates. And while nothing has changed in the past month to impact REIT valuations, as you've noted just a minute ago, the sector was the strongest performing sector over the past month. Many of the REITs are up double digits. In fact, probably most of the REITs we cover are up more than 10% over the past month. And that's clearly because of the long-term bond yields coming down. And to the extent they remain stable or come down further, we think REITs could have a good year next year. But yeah, it definitely requires inflation to continue to moderate, which is a scenario that we're optimistic in, and it seems to be the general consensus, but it's not a given.
We are tight for time, and I'm so sorry. Among your best ideas, Granite, Killam, Minto Apartment, Primaris, and Flagship Communities. We can put that board up again. But I just wanted to ask you, you have downgraded CapREIT and InterRent, but is that just to hold? Is that simply valuation?
It's simply that the stocks had decent performance, decent runs. They both are exceptionally well positioned due to strong immigration to Canada. The market rents have gone up considerably. There's a huge spread between in-place and market rents. And both of those REITs are very strong, well-managed, high-quality REITs that will continue to do well. It is simply that we think there's a couple of others in the apartment sector, Minto and Killam, as you mentioned, where we think there's probably a little bit better value. So we have buy rating on them, but you're going to do very well and probably get good returns over the long term from both CapREIT and InterRent.